Welcome back, everyone. We appreciate you sticking with us through our short break. Following insights on industry transitions, we now focus on investment strategy. Liza Jansen, Head of Responsible Investment at Prudential, will explore how major investors integrate climate and sustainability. Moderating this discussion will be Henry Soediarko from Miltrust International. Please welcome Liza Jansen and Henry Soediarko. Henry, the floor is yours.
Thank you very much, Naja. Good afternoon to all of you. I hope I'm not standing in between your first day of the week and your lunch. First of all, I would like to introduce Liza Jansen. Liza is a Dutch national. She heads up the sustainable investing practice at Prudential Investment globally. Although Prudential is headquartered in Hong Kong, Liza is actually based in Kuala Lumpur. We are very fortunate to have Liza near to us physically. I hope with this session we can share, we can learn from Liza on how Prudential look at sustainable investing. Right. Let's go straight dive into the questions. Liza, can you elaborate on Prudential's view on responsible investments or your own view?
Yeah, of course. Well, first of all, thank you for having me. So a very, very short introduction to people who don't know Prudential. So we're a life and health insurer, originally from the UK, but now only operating in Asia and Africa. So indeed, I cover all of these markets on responsible investment. So basically what I'm trying to do is trying to integrate sustainability considerations into our investment practice as, well, we invest all the money, all the premiums that we receive on the insurance products that we sell. All that investments is all that money is being invested. So that's basically my job. So on responsible investment, the view from Prudential is very much informed by the considerations for emerging markets into the responsible investment debate. So you might know responsible investment really started from Europe and actually started from the Netherlands, where I'm from. And it's always been very much a European viewpoint. So responsible investment standards, responsible investment guidance, how to report and everything is very much informed from a European point of view. And that doesn't always work for emerging markets and other parts of the world. And that's something I actually realized starting when I started work at Prudential, because I come from Netherlands. My previous job before Prudential was in the Netherlands. That particular pension fund did have an allocation, for example, to emerging markets, but similar to actually almost all investors, they were just using the frameworks, the same standards they were using for developed markets and also applying it to emerging markets. But emerging markets are very, very different. So take climate change, for example. That's one of the biggest topics within responsible investment. Not the only topic, though, but one of the biggest ones. And emerging markets, tend to be more carbon intensive. They tend to have less capital available to them to make the transition. But they also tend to, they didn't have play such a large role in historical emissions, for example. They're not as responsible for the current climate change problem that we have, because developed markets historically have emitted the most carbon emissions, while emerging markets currently emit the most carbon. And that's true for most sustainability topics, like whether you talk about deforestation, for example, as well. Deforestation, again, a lot of focus on emerging markets, but developed markets historically have done a lot of deforestation as well. And these kind of viewpoints often are not included in the discussion and in those frameworks. So what usually happens, which is very unfortunate, is when you have an investment fund that includes something like sustainable, ESG, climate, basically any of those terms, and it's a global investment fund, usually the allocation towards emerging markets is just lower than if it's a general fund. So these responsible investment frameworks very much focus on divestment, very much focus on things you shouldn't be investing in anymore, lead to a bias against investing in emerging markets. And that's something that we're very much against. We don't think that's actually helping the sustainability journey on whether it's climate change or any of the other topics. We should be actively supporting these markets and trying and provide capital to them so they can make that transition. Because the transition on any of the sustainability topics usually costs money, at least in the short term. While the savings might be there, especially in the longer term, short term, they might require capital. So just leading to just having them underweighted in these kind of sustainability investment strategies is really not helping. And that's what we're very much focused on at Prudential within responsible investment, because these are the markets in which we operate. We operate in these markets, we invest in these markets, we ensure the people that are living in these markets. These are our markets, and we don't want to move capital away from them. So that's very much the focus on responsible investment for Prudential.
Thank you, Lisa. I think that's very, very encouraging and very refreshing, given the fact that Prudential understands where it operates, also understand what it should do in terms of the sustainable investing in the market they operate. How do you see the difference between, ESG, responsible investment, climate investments? Are they all the same, or are they all the same with a slightly different names, or there are some real differences on this?
So I think there's quite a lot of confusion on responsible investment, especially because of these terms. People have different understanding of these kind of terms, and not always is the understanding aligned. But people use them as if everyone understands what we're talking about. So ESG is of course the acronym for environmental, social, and governance, and that's how we used to call all sustainability. We've seen lately kind of a switch from ESG to sustainability, I think, to broaden the concept a little bit. But initially, ESG was very much focused on how companies operate, not so much on what companies do. So probably a lot of people are familiar with ESG ratings, but there also have been quite some negative press on ESG ratings. For example, there were questions on why certain companies that had a negative impact on society because of what they do still had very high ESG ratings. So, for example, in press was highlighted how is it possible that oil and gas companies or tobacco companies have very high ESG rating, yet there is kind of a agreement that the impact that these companies create is largely negative because of climate change or because of the health considerations from smoking. And that was because ESG focused very much on how those companies operate. They didn't take into account what that company was producing, so oil and gas or tobacco. It was focused on, what kind of labor practices do they have? Do they have the policies in place? Do they have an environmental policy trying to bring the carbon emissions down, but maybe not, pivoting away from the product itself, which is, very carbon intensive. And that's where I think a lot of confusion on ESG came in, because suddenly ESG was saying, well, you're kind of greenwashing, right? But that started from the fact that ESG, the term, focused very much on how a company operates. Now, to me, then responsible investment is broader. I think it's very important that we look at how companies are operating, because there are sustainable companies that produce something that's good for the world, like solar panels or EVs, that operate in a way that's not necessarily very sustainable, that don't treat their employees very well, for example. But I think we also need to look at what companies do. Like, what are they producing? And to me, that's responsible investment. So trying to incorporate everything. And then within responsible investment, you try to cover all of the different sustainability topics. So that's climate change, it's nature, it's diversity, but also board executive remuneration, for example, how the governance of a company is set up. And all of those things are covered by responsible investment, but climate is one of the largest topics within those. So climate investments is then a subset of responsible investment, because climate change is so important, so financially material to investors. By far for us, the most material financial ESG sustainability risk is climate change. So that's why there's so much focus on climate change. But my function covers more topics than just climate change, although like 90% of what I communicate about, especially in these kind of panels and things, it's climate change.
Thanks, Lisa. I think this is very interesting because a lot of us, including me, so I run a small climate fund, right? And it's people are so unaware of what the difference is between this ESG, responsible investment, and even they often said that, like exactly what you pointed out. Why does certain companies have high ESG ratings, right? And people don't know what are the difference. I sometimes have an issue with this as well. But coming back to this, right? On the first point that we see, I mean, it's very interesting that you said that, historically it has been the developed market that emits the most carbons, right? Um, you know, um, Regulation in emerging markets is not very supportive, right? As one of the Bloomberg you know reporter pointed this morning, momentum is just not there, unfortunately. I've seen this as well. From your point of view, what would you, or how should we tackle this issue?
So actually, I don't agree. I think there's a lot of regulation, especially here in Asia, that is very supportive of the transition. I won't deny they're lagging between after developed markets, but it's also now, considering the current geopolitical environment, quite difficult to group the developed markets together because we usually think of Europe and the US, and there's now such a huge difference between Europe and the US. I'm just gonna stick to Europe. So I think a lot of markets in which we operate actually have some regulation in place on especially reporting and also requiring targets on net zero targets by the companies. There is quite some interesting things happening. Now they're indeed lagging behind Europe, but then Europe is pioneering. All of these kind of things is new. They also realize they might made the reporting burden on individual companies a little bit too high on sustainability, which is why we're seeing a little bit of a rollback in the EU at the moment. But what I think is really interesting is, especially if you see here in Asia, but especially in Malaysia, they're looking at what Europe is doing and they're trying to copy whatever Europe is doing, but that works. And for now, ignoring kind of the rest, because not everything works and not everything leads to the intended outcomes that we want. So I would say, especially, I mean, it's still moving in the right direction. It's definitely not as much regulation, and we would like to see more because we need an enabling environment to see these kind of investments for them to be commercially viable for investors like us. So things like a carbon pricing would really help, and that's definitely something where EU is still very much ahead of others and are now kind of exporting that carbon price to the carbon border adjustment mechanism now as well, which if kind of puts a global carbon price in place. And so those are the kind of things we would like to see more in our markets, but we understand how challenging it is for some of these markets. So in ASEAN, there's still millions of people that don't have access to electricity. So just decarbonizing the electricity grid becomes a lot more challenging if you're also trying to get everyone connected to the grid. And at the same time, there's a huge increase in electricity demand, an increase you don't really see in the EU, at least not to that extent. And then these kind of things do have to be taken into account. So we do understand how that it's just more difficult for these countries to pivot, to transition basically, while making sure that they're also taking care of all the social goals that they have on eradicating poverty, most importantly, which is something that's also very, very high on the agenda of these markets, which is also on the agenda, of course, in the EU. Not saying there's no poverty, but less of a topic than it is here.
Thanks for this, Lisa. Just going down a bit deeper on the investment side. Um, there are some people who talk about, investing in climate. You got to start from the startups or even venture capital, clean tech, or even listed equities. Some people bring it to the next level and say, why don't you invest in real assets, right? Are you actively investing in nature-based solutions or biodiversity resilient infrastructure? And this can be forestry or farmlands. And how would you evaluate the ROI on such assets?
So I have to say, unfortunately, no. It's too difficult at the moment for an institutional investor like us. So we have our own strategy and what we're calling financing the transition. So last September, well, actually September 2024, we came out with our financing the transition framework. And we have an internal AUM target on investing in investment funds that align to our financing transition framework. And it focuses very much on climate. So it focuses on climate solutions, but also trying to invest more in companies that are transitioning. And the importance of transition plans of companies. Now, our framework applies to all of the asset classes that we invest in. So unfortunately, we don't do venture capital. Because for an insurance company like us, that's too risky. It's not something we can do. But we do private equity, more mature private equity, and we do listed equity and corporate bonds and infrastructure and real estate. We do a lot of different asset classes. And I believe that all asset classes are needed to fund this transition, especially the energy transition. The funding gap is so large that we have to, for example, use the capital market to listed equity and corporate bonds to actually fund some of this transition. We can't just rely on venture capital. But then within the financing and transition strategy that Prudential set up, we included nature. We included also climate adaptation, so making us resilient against the physical impacts of climate change. So we have been engaging very much on nature investments. So engaging with asset managers, with our peers, with others in the market, trying to find nature investments we can include into this investment strategy. Now, Prudential is, of course, an insurance company. We have a fiduciary duty, which means we have to act in the best interest of our policyholders. So our fiduciary duty is always most important. So it means that these type of investments need to meet the regular risk return requirements. We're not going to give up return because it's not our money. It's our policyholders' money. So that's always most important. So we're looking for these investments, for these nature investments. And every time we see them, we have to conclude, unfortunately, at the moment, we can't do it. First, there are a couple of reasons for this. First of all, these type of investments tend to be very concentrated and very risky at the moment. So indeed, they focus on sustainable forestry, which is a separate asset class, which usually doesn't have that high returns. But then they generate additional return by the issuing of carbon credits. So they sell carbon credits in the market. So private companies usually use those to offset some of their own carbon emissions. And that's an additional source of income. But that additional source of income is very, very important and very needed. But at the same time, it's also very risky because the price of carbon credits fluctuate quite a lot. There's a lot of concern around greenwashing. So it just means that the return on these type of investments is quite low. And then at the same time, well, it's actually for that type of investment, it's not that bad. It's just at the same time, we have regulation in place. We are being regulated and we have to, based on that regulation, we have a certain required rate of return. And since these kind of investments are still relatively new, they're seen as very risky from a regulatory perspective. So our required rate of return is too high for these type of investments. And that's very unfortunate because even though the risk might be lower of these type of investments, just because the regulatory environment has not caught up yet. And there can be good reasons for this. Don't get me wrong, I'm not criticizing the regulators because the regulators, they have they have a different objective, right? They need to maintain a financial stability. So constantly adding new kind of asset classes and new kind of risky investments and allowing institutional investors to step in creates its own kind of risk, right? I mean, we're talking about nature, and I think we're very supportive of nature, probably the audience as well. But things like blockchain and cryptocurrency and these kind of things, we can't really do for the same reason either, which I think there is a good reason to not allow institutional investors to en masse start investing in crypto because it's extremely risky, right? And with my money, that's backing insurance policies, I also wouldn't want insurance companies to take that kind of risk, right? It's just too high. So I'm not saying they're not good reasons. I'm just saying because the market is so new, there's a kind of mismatch right now. I think another type of thing that we could do is nature is kind of indeed defined as you define it right now. So you define and you invest in forestry. You invest in mangrove protection because it's so important for flooding risk. And these kind of tangible real assets into forests. But you can also define nature much more broader. You can think of sustainable agriculture, for example. And these kind of things are more investable for us. So I think purely from an investor perspective and the community who kind of sets expectations on what nature investments are, I think we can have a rethink, and we are currently doing that work on what does it mean to invest in nature and not just look at those kind of forestry things, which are so difficult to do for us. Also look at sustainable agriculture and precision irrigation, for example. These kind of things that are also very important from a nature and biodiversity point of view, but are just a little bit more commercially viable for investors like us.
This is very heartening, Lisa, to hear about how you try to balance between moving capital to help the earth to be sustainable, but also at the same time looking after your policyholders' money, right?
Yeah.
And I'm so glad about when you said that, look, there are some risks that we cannot take. There are some risks that we can take, right? And it's not all in nature-based solutions, but you don't close your eyes to that entirely.
Yeah.
Fantastic.
So actually, this is Prudential's kind of obligation, right? But also my personal belief. I believe very much if we can't convince institutional investors like Prudential that we can do those type of investments while still meeting their fiduciary duty, we can't mobilize the amounts of capital that we need for all of these transitions. Because if we constantly have to rely on philanthropies and these kind of like Bill Gates Foundation, we're not going to get there. So we need institutional capital. So we need to find a way how to integrate these type of investments into the investment frameworks of institutional investors, where the large pools of capitals are, because these are the very large investors. The pension funds, the insurance companies, sovereign wealth funds, although they might have a little bit more flexibility, but they have the most capital that's being invested into the economy.
Excellent. Just looking at back down a bit further, we've talked about investments at the early stage of our conversations, and we recently covered about the how about investing in other non public equities, right? Just to take up the risk a notch a little bit. But when we talk about risk, how do you assess a physical climate risk? I mean, we've seen floods happening recently. It's typhoon in Hong Kong. Some time ago in Malaysia, even in Thailand, right? How do you assess physical climate risks in your investments, and how is this priced into the assets or any valuation premiums or discounts?
So this is very difficult to do. So we're first of all, it's important to understand we are an asset owner. And we usually work with asset managers. So we own the capital because, we're the insurance company. And usually we have, almost all of our markets, we have regulation that we have to select asset managers to actually do the investment for us. So as an asset owner, our role is very much selecting asset managers and their funds, or we can also set up segregated mandates so we can dictate a lot better on how they should be investing. But in general, we're a little bit one step removed from the actual investments. Now we have an in-group asset manager called eSpring. So Prudential Group is kind of an asset owner and asset manager at the same time. So I'll talk a little bit about asset management as well. But we invest in a lot of different companies because we need to spread the risk. And diversification incredibly important for any investor. So especially if you count listed equity and corporate bonds, we invest in tens of thousands of companies. So what we usually do for not just sustainability, but also for regular risk management, we rely on data providers, on external companies that collect a lot of data and that share that data with investors like us, and it flows through our systems, and that's the easiest way to manage these things. So we don't go out ourselves to assess what the carbon emissions are of this particular company. We get that data from an external data provider. Now, that also means you rely a little bit on those data providers on how they collect the data, but they very often also offer tools on how to assess certain risks, especially on climate. So we rely a lot on these tools as well. Now, the physical impact of climate change is extremely difficult to measure because it's so very local. And again, when I started, I said there's very much responsible investment is very much coming from that European point of view, but also a one-size-fits-all kind of view, that all risks are kind of equal. Not really taking into account where that risk is happening. So that is kind of true for climate change, because carbon emitted in Europe versus carbon emitted in Asia, it doesn't really matter, right? Eventually it all leads to climate change, and you need global emissions to go down. Now, but physical impact of climate change is very, very local. And that becomes then a problem because it makes modeling so much more difficult. You have to understand the local circumstances. So to take an example, we just gone through a whole review of different tools and how to assess climate risk within the organization. And we were looking at different tools, and we have quite a large exposure to Malaysia. Prudential Malaysia has quite a large business for us. Also, other business units are investing in Malaysia. So relatively large exposure to Malaysia. And yet Malaysia was popping up so frequently as one of the highest risk on climate change that I thought, well, even considering a large exposure, still, this doesn't make any sense. So I started asking questions on why this is happening. And the problem with a lot of these tools are a little bit black box, so you don't fully understand. But one thing they did find out, and they said they were incorporating heat stress. So I asked them, what's your definition of heat stress? When is something stressed by heat? And it said, well, if the average daily temperature on any day is more than 25 degrees, then it's defined as heat stress. Now that's a regular day in Malaysia. So we looked up together with the data provider, we looked up a Malaysian asset, and it hit, was heat stress for 365 days out of the year. So all days it was. Now, obviously, an average daily temperature in the Netherlands, where I'm from, of 25 degrees is very high. It's defined as if it's more than 3 days, it's defined as a heat wave, because you have larger difference between day and night temperature and everything. So an average temperature is very high. Malaysia, it's a normal day. So that's why Malaysia was so popping up so highly on these kind of things. So that means we really struggle finding very good tools on how to assess this kind of risk on a portfolio perspective, because our portfolio is so large and so diverse. Now, when we work with these asset managers and we look at individual funds, and especially on funds like infrastructure and private equity, the number of holdings tend to be a lot lower, and they tend to be a lot closer to the investments. They know the investments better, and investment managers can take that local view. because they usually know what the local circumstances are. And then those are the kind of things we focus on very much when we talk to these asset managers. Take that local view when you start assessing this, and then assess the risk properly. Start incorporating it into your whatever valuation model that they're using, very often like a discounted cash flow model or something. So you discount just like you would treat any other risk. If they see a risk for that particular investment, if it's political risk, for example, they also apply a discount to the investment. So same with climate risk. If they see climate risk that's not properly managed, apply that same discount the way you would do any other risk. So I would say on certain funds, since with certain managers, we're managing physical risk of climate change quite well for the entire portfolio, and we have to rely on these tools which are biased again against, countries that are around the equator and have more like tropical climates that tend to be emerging markets. We can't really use those outcomes right now because it's just we don't trust the outcomes, and that's basically it. We do see a lot of changes happening, and it goes very quickly. So people are aware of this. They are people working on these kind of tools. They're taking these things into account. It's getting better, but there need to be investors like us, and I know there are others that are raising these kinds of issues. Like this just doesn't work because now we already investors had an incentive to start divesting from emerging markets because they're so carbon intensive and not doing so well on sustainability. Now, if they want to manage physical risk on paper, not in reality, but on paper, they might also move capital away from these markets. But obviously, the world is very complicated and very integrated. Even if you just invest in companies in developed markets, these companies have supply chains in emerging markets. You can't diversify away that risk in your portfolio. You always have exposure to these markets because every country has become so reliant on them. But yeah, that's
I agree. I think
one of the many challenges we're currently having.
no, I hear you about this. I think this is very interesting because, like what you currently pointed out, 25 degrees, right, is actually a cool temperature to be this part of the world, right? I would be very, very happy if it is 25 degrees every day in Singapore or in Malaysia, right? Because that means we can wear our nice jackets and we don't really sweat, right? But it is also a proof that what you said is absolutely correct. It then has to be a local understanding of physical climate risk or even climate risk in general. And that means it's going to be extremely complicated to model, right? And therefore, what is the solution for this? Maybe it's for all of us to gather together and argue for the next 10 hours, and then we'll find out, right? Anyway, but yeah, to your point,
but anyway,
exactly. To your point about how difficult it is to get or to understand some of this data from the third-party providers. I mean, I find it challenging because one, I think we're all new in this, right? Number two, like what you said, it's there has to be some localization of certain scenarios and certain data. And I think everybody is just trying to work on this, right? So we have to give it, have to clap our hands for them, but we also need to nudge them a little bit to get to the right directions, I think. And we all have responsibility on this. I noticed something interesting about Prudential's approach on responsible investing is to reduce the weighted average carbon intensity. How do you differentiate between so maybe just maybe you can start with what do you mean by weighted average carbon intensity? But before you go on, and the next question is how do you differentiate between low carbon and truly climate resilience type of investments in your due diligence process before you pull the trigger? So let's start with your definition on, or Prudential definition on, weighted average carbon intensity. Go ahead.
So Prudential is, I think it's important to understand, Prudential both a very global investor and a very local investor. So we have some business units that can invest globally, and we have some business units like Malaysia and Thailand, they mainly invest locally. That global portfolio that we have allows us to have some flexibility in how we manage our assets, and it allows us to join international organizations like the Net Zero Asset Owner Alliance. So we're a member of that alliance, and we committed to be net zero by 2050, and we also committed to follow their protocol and how do you set targets for your investment portfolio. So one of the requirements is to set a decarbonization target, and for investors, there is guidance available from the Net Zero Asset Owner Alliance and other organizations. That one of them, there are a couple of metrics you can choose from, and for you to measure the carbon footprint of your portfolio, and one of them is the weighted average carbon intensity. Because carbon emissions is usually something you emit yourself, right? You have a factory, that factory emits carbon, you measure that. For an investor like us, we do investments, but in that process, we don't really emit anything ourselves. However, the companies that we invest in and which we own emit that carbon. So what we're trying to do is to say we are responsible for part of those carbon emissions of those companies, and we assign it back to us. And that's the carbon footprint of our portfolio. Now, there are basically two things you can do. You can say, okay, I own 20% of this company, 20% of one company and 20% of another company. I take 20% of the absolute carbon emissions, like 100 ton of CO2, and I allocate it to myself. And then add that up, and you get to a number. Another thing, what that doesn't take into account very much is the difference in size between those companies. So one company can, for example, be very large, also have a very large carbon footprint, but relative to other companies that are smaller, they might have a relatively lower carbon footprint, are more carbon efficient than any other company, if that makes sense. But just purely from a size perspective, large companies tend to have large carbon footprints. So what we mean by carbon intensity is that we correct for that size, because we don't want to start favoring small companies just because they have a small carbon footprint because it's a small company. We want to allocate more capital to companies that are relatively carbon efficient, that despite their large size, have a relatively low carbon footprint. And that's why we're focusing on carbon intensity. So I understand that's quite complicated, and that eventually that number, so for our carbon footprint, it ranges between 150 and 300. That number itself doesn't really mean anything because it's just a way how we assign the carbon emissions of the company to ourselves. But it is very useful to ensure that we're not just divesting from large companies and moving capital to small companies, because that's not going to solve anything. You want to make sure you're allocating capital to the ones that are most carbon intensive, more carbon efficient. So that's why we set a target on that weighted average carbon intensity. But there are many drawbacks with this metric, even though it's still the best metric, I think, to measure the carbon footprint of a portfolio. It very much focuses on current emissions and not whether that company has any future and transition plan or any decarbonization target in place. It's just purely backward looking. And then there's a lag with the data as well. So usually 1 to 2 years. So it's technically historical data, even though we present it as current data, because it is the most current data that we currently have. But there are all kinds of challenges with this metric that can lead to unintended consequences of just moving capital away from currently carbon intensive companies, while they might become less carbon intensive over time. So we have a decarbonization target. It's actually linked to remuneration of our executive management. And in contrast, we also have a financing the transition target, also linked to remuneration. And financing transition tries to take that forward-looking approach. So not just looking at the current footprint of portfolio of companies, but also, do they have a net zero target? Do they have a transition plan in place? And we should take that into account. And we've been very transparent externally that we might think those targets might conflict a little bit on the short term. Because for financing transition, you want to finance the carbon intensive companies that have a transition plan, but are currently carbon intensive. So in the short term might increase the carbon footprint of the weighted average carbon intensity of the portfolio. But we've been very transparent about that. We still like the weighted average carbon intensity target for the portfolio because we like to align to as your Aston Alliance. We like to be a member of that because then we can have influence on the standards. But then at the same time, we also know that in the short term, our carbon footprint might actually increase if we do these type of investments. So I think that's a key thing to understand. The carbon footprint of the portfolio very much backward looking. So you're basing your decisions on historical data. Well, for transition investments and climate investment, you hope to be more forward looking on projecting what the company is going to do because you're a long-term investor. You want to be invested in that company long-term.
And how do you differentiate let's go back to the second question. How do you differentiate between low carbon and climate resilient investments?
So climate resilient investments would then be the companies and the investments that manage their climate risk very well, that have this net zero target, that have decarbonization targets, that are also preparing themselves against the physical impacts of climate change. Well, not completely ignoring, but not giving as much weight to the current carbon footprint of that company at this moment, whereas the weighted average carbon intensity of the portfolio only looks at the current carbon footprint of that company. So it's a difference between backward looking and forward looking.
Great. I'm conscious we only have less than 20 minutes. One thing that I would like to ask, and I think this is quite important. I noticed earlier you said that look, you have Eastsprings that you work quite closely together as your probably I would like to say one of your key partners, right? But you also invest in other firms. How do you train or how do you hold your other partners' investment teams accountable for the ESG integrations? I mean, what incentive and structure exists for this? You mentioned earlier about some of the your management have their key remuneration tied up to the carbon intensity of your investments. But how about your partners in the investment?
So it depends a lot on whether it's Eastspring or whether it's an external manager. Obviously, with Eastspring, we have a lot more influence. So Eastspring is a part of the group, Prudential group, and we have the way we require sustainability is mostly through policy setting. So as you can imagine an insurance company like Prudential that's heavily regulated has a lot of policies in place and a lot of risk policies in place, from operational stuff to, sustainability as well, of course, but all kinds of policy and just managing that risk. So we also have a responsible investment policy. And that responsible investment policy is a group responsible investment policy, and that word group is very important because my team is responsible for setting up that policy and putting in the requirements that they have to do. But it applies to Eastspring as well. So there are hard requirements on integrating ESG into their investment process and being able to demonstrate how they do this. And of course, when you have an official policy in place, all kinds of other governance, takes off, like audits can come in to request, the proof that they've actually done this. But also, if we find out they're not doing this, there can be a breach reported, and that sets off all kinds of things internally. But that's the most important, for me, the most important lever to make sure that they're actually doing what we require them to do and what they say themselves that they're doing. Now, obviously, still can be a difference in kind of the level that I want and the level that they are demonstrating. And then we tend to focus more on the softer kind of things, providing training, explaining clearly what kind of things that we want, also understanding, just also in these trainings, being very much understandable on the kind of challenges that they have. They still have to meet return requirements for certain investment funds, of course, need to be very sensitive to all of these challenges, but then at the same time, trying to push them as far as they can go. So I think for eSpring, we have quite a lot of influence. We work with them very, very closely, by the way. It now sounds as if we dictate everything that they need to do, but we actually have a very close collaboration and we take input from them as well on what we should be doing. With external managers, obviously it's very difficult. We don't have that much influence over them. Mostly, the most influence that we have is to walk away. Is to not invest through them. So we integrated responsible investment considerations into the due diligence, into our manager selection. So the first time we interact with them, they immediately see responsible investment very important to us. And it can be a reason why they're not being selected. Obviously, when you already invested in them, we constantly, well, not constantly, not that frequently, but occasionally we switch managers. And if they do something on sustainability we don't like we've seen recently a lot of managers pulling back from certain initiatives, we raise these concerns, and it could be a reason on why we are in the future considering a different manager. But that's a crucial difference. You're an external manager or one of many clients, and we can be very vocal. Asset managers tend to listen very well to the asset owners because they are the clients and we're a relatively large one. So we have some influence and we use that. But eventually, if they really don't want to, we can't force them. The only thing we can do is not invest. And usually that
Just
is
walking
that
away.
signal. So yeah, walk away.
Well, fantastic. Now, I think we've talked a lot about your policies and how do you work together with your internal stakeholders like eSprings and others and other parts, right? I'd like to touch base on carbon credits, right? This is something that that it's rather controversial to a lot of people. Some people think it's bridging tools similar to natural gas. What if as you know, Tesla actually makes close to $1 billion, if not $1 billion, from selling regulatory credit, right? Not many, right? Or even almost none of the Asian companies' material portion of their earnings comes from selling regulatory or carbon credits. What do you think of this? And are there potentials on investing in Asian companies just based on this alone?
So carbon credits can mean different, again, as with ESG, can mean different things to different people. Usually when people talk about carbon credits, they mean the carbon credits that you get from reforestation. So you plant a new forest and then you sell the carbon credit, the carbon that this kind of forest is absorbing, and you're selling that to companies to offset their own carbon footprint. What Tesla is doing is different. So Tesla is claiming that they're avoiding carbon, which is true. I mean, if you buy a Tesla car, you're avoiding carbon because otherwise you would have purchased a petrol car, which emits a lot more carbon during when you're driving it. So based on that kind of assumption, Tesla sells these kind of carbon credits, but based on avoided emissions. Now, these avoided emission kind of methodology, that's always the one that has the most negative criticism, because you can argue, well, this is just something that companies need to do, and everyone needs to decarbonize. So if a company is just decarbonizing by profiting from the decarbonization of another company, you're kind of double counting, right? Tesla is already reporting decarbonization because their carbon footprint goes down over time. And at the same time, they're selling that to another company, and the company is also claiming, hey, I have decarbonized because I purchased these credits from Tesla. So there's a lot of criticism, especially on those type of carbon credits, and the price of those tend to be quite low. To be completely honest, I think there's going to be some regulatory regulation around these carbon credits and what carbon credits are allowed to be and what not. And then these kind of carbon credits that Tesla is issuing probably will either have a very relatively low price because the added value is not that high, or just not allowed. Now, obviously, they're profiting in the short term. I think
Sure.
two reasons why we don't really see that. We don't see that many of these kind of companies in Asia. We do see them a lot in China, but China is less connected to financial markets than the rest of the world. So we see them less in the rest of Asia. But then secondly, also, you need to have a functioning carbon market system, and you need to have these kind of functioning supportive environment for you to actually be able to sell these carbon credits. And that's another thing that's happening less in Asia, although there are certain markets like Malaysia very much focusing on this right now, setting up that exchange. Hong Kong is doing the same, trying to enable this. But I think one important point to carbon credits is actually related to those forests, because I think that's something especially emerging markets can profit from quite a lot, because emerging markets, even though everyone is very much focused on emerging markets for deforestation, especially Southeast Asia, but also Latin America. And yes, there is quite a lot of deforestation going on in these markets. At the same time, they also still have a lot of forests. So we need to be able to we need to be able to find a way for these markets to monetize these kind of natural resources without cutting them down. Because that's how developed markets previously have monetized these natural resources, cutting down the forest and turning it into something more productive. We can't afford that as the world for emerging markets to follow in that same pathway. So we need to be able to for them to get a revenue stream from those natural resources, but by keeping them intact and protecting them. And then carbon credits can be a good solution. And I'm really hoping for that, because we need a solution to that. We need a way for natural resources to generate its own rate of return. Otherwise, that's the biggest incentive just to cut it down, because you can turn it into a plantation, which will give you an economic return.
That's right. Now, maybe we have a hard stop at 1:56 or so. Now, I think this should be the last questions. Now, some investors deem that EV is the solution for clean transport, but the production apparently has higher emission compared to conventional cars, right? What's your take on this?
I think we always have to look at the entire life cycle of a product. So not just production, but also what does a product emit when you actually use it. And that's what they call Scope 3 emissions, which for oil and gas companies conveniently very much ignored, because a lot of oil and gas companies focus very much on that production process and trying to bring down that carbon footprint, but then ignore on how much carbon is emitted when you actually start burning the stuff, because that's when most of the carbon is emitted. And for EVs, it's the other way around. This kind of criticism focuses very much on the production of EVs, but it completely ignores that once it is produced, it doesn't really emit any carbon anymore. Because once you start driving it and it's driving on electricity, it's not emitting any carbon anymore. Of course, the electricity was generated and that one emitted carbon. But even if you take the most extreme example, saying all that electricity that is used for that car is generated by coal, the most carbon intensive source of electricity, it's still over a lifetime, it's shown that EVs still emit less carbon than regular cars. So I'm still very supportive of EVs. I'm also more of a practical kind of sustainability professional, I guess, where I think I think we need good public transportation. I think we need all of these investments as well. I think it's not possible to stop people driving cars. I think that's just not gonna work, because, well, everyone likes their cars, and I think we need to be practical and realistic. that's not a reasonable way forward. So try to make sure that that car in itself, especially over the lifetime, emits less carbon, and then at least we can tackle the problem. Because having these kind of idealistic but not very realistic ambitions of just stop driving a car, is just not realistic. So in short, very still supportive of EVs if you take the full lifetime into account of a car.
Right. Thank you very much, Lisa. I'm extremely in agreement with you in terms of having EVs actually is probably one of the better solutions, despite the fact that production-wise, probably emit higher emissions for the time being.
Yeah.
I'm pretty sure as the technologies improve and matures, I think the emission for the production will be less. Now, I would like to thank you very much for your informative session and extremely passionate info sharing. We are actually closing to the nearby to the closing of this session. I would like to thank you, remotely and personally next time. I'm in KL. Also, we would like to express our most sincere thank you to Climate Governance Malaysia for giving Liza Jansen and from Prudential and myself, Henry Soediarko from East West Private Wealth, the opportunity to discuss what we think is best for the earth in terms of investing. Thank you very much, and so long.
Thank you.